Who doesn't want to become rich? The sound of becoming a crorepati definitely rings a bell, definitely alerts you. We all want to know how to grow our wealth, how to get rich. Investing your money right is one way to do it. Do mutual funds come to mind? While mutual funds are surely subject to market risk, one cannot dream about becoming rich without one share of risk involved. Good afternoon. We are back with the third edition of Manager Money. This time, we are going towards a very interesting turf. We have our guest speakers talking about investing in mutual funds to become a crorepati. They'll share the best ways to invest money for the best kind of returns in the long term, the risks involved, consistent performers, and also around the sectors one might want to stay clear of to avoid such risk, among many other facets of investing in mutual funds. We have two very insightful sessions for you to get to know about investing in mutual funds a little bit better. Before we start, the official hashtag for this monthly knowledge series is hashtag FEMYM. Do tag us on your posts and queries around anything money, investment, and personal finances. Now, our first session is a fireside chat on building a resilient mutual fund portfolio that can make you rich. Our speaker, Radhika Gupta, is the MD and CEO of Edelweiss AMC. A keen microblogger on Twitter, Radhika is also known for her blog, The Girl with a Broken Neck, that has garnered over 2 lakh views. Welcome, Radhika. The session will be moderated by Shaleen Agrawal from Financial Express Online. Over to you.
Hello all. My name is Shaleen Agrawal. Welcome to Financial Express Online. Manage Your Money edition. We are discussing today how to get rich, how to become a crorepati by investing in mutual funds. We have with us Radhika Gupta, MD and CEO of Edelweiss AMC. Radhika, welcome and thank you so much for joining us.
Thank you, Shaleen.
Radhika, you've recently launched a book called Limitless, The Power of Unlocking Your True Potential. Could you talk a little bit about that? How did the book come about?
Sure. So while the book is, of course, not a finance book, and this is a finance conversation, incidentally, it does use a lot of personal finance analogies and examples, by the way. It's a book that hopefully will reach a lot of young people in India who I think have incredible potential. And it's a book that hopefully addresses some of the sticky situations we all face as we navigate our careers and build our dreams, especially in our 20s and 30s, and issues that are often less spoken about, issues like rejection, issues like how to work with people, issues like what do you do if you don't like your first job. And it really came out of a conversation with my publisher, Hatchet. I wasn't keen to do this. I always thought it would be a late stage post-retirement project. COVID also happened. So less travel meant a little more time on the weekends to do this. And lo and behold, so I always believe in some way, every crisis, whether in money or life, also poses an opportunity. And this was the one that came out for me out of COVID.
Has it come from some personal experiences where you might have faced limitations as especially a young woman in business when you were starting out in Mumbai?
So it's definitely a book that is chronicling personal experiences. It's not a autobiography in any way. I'm way too young to write one. But I would say about 60% of the book is personal experiences. The rest is anecdotes, beliefs, and experiences that I have seen and observed. I would say it's an experience of a young person trying to build a career, not a young woman trying to build a career. There are a lot of books written in the, what do I call it? The women's genre, which talk about the challenges of women at work. Limitless is not that. It is very, very gender agnostic and I don't take away from the fact that women have their set of different and unique challenges at work, but those have been addressed by so many wonderful global and Indian books that I didn't feel the need to do that. This is a young Indian's perspective to navigate opportunities in an India that actually gives you, as the title says, limitless opportunities.
Radhika, we'll come to the topic at hand. Today we are discussing if people can become or think of becoming a crorepati by investing in mutual funds. So I'll start with that question itself. Can a young person starting out in their first jobs aspire to do that, to become a crorepati in 10 to 15 or 20 years by investing in mutual funds?
Yes, you can. Of course, you have to start with a meaningful amount of money and you can do the back calculations. But I think what is important is not just starting with that money and saving that money, but developing the habit of consistently investing. One of the themes and tools that I believe in mutual funds is incredibly powerful is the SIP or the systematic investment plan. And I believe that if an individual at a young stage, because you then, when you have 15 years, you also have 15 years of equity compounding. I believe that if you are an SIP investor and, you keep saving a small amount every year, and the reason I'm saying that also is because I know everybody today as a young person, you don't have 50 lakhs that will become a crore or 25 lakhs that will become a crore. Most of us are salaried professionals who have limited income. But within that constraint, if you build this habit and if you do it month on month, and if you ride out the corrections, don't redeem during the corrections, which is easier said than done, don't stop those SIPs, you'll be surprised 15 years later that crorepati outcome is not a difficult one.
What is a reasonable return expectation over long-term equity compounding?
Okay, so now, and I always get into trouble because I'm extremely conservative in my projections. I think you should expect 12 to 15% returns from your equity funds. You should expect about 5 to 7% odd returns from your fixed income funds. And if you're doing balanced funds, then that number is closer to 11 to 12%. It is very important, and I'm saying this now, to have realistic expectations from our investment instruments. The last 2 years have been exceptional years in terms of equity market returns, and people almost feel that 20-30% is guaranteed. It is not. The great thing, and I'll also say that since you asked me this question, I said in the book too, people expect and get 12 to 15% on average from equity, but that average is a very dangerous word. It doesn't come consistently. So you will get plus 30 and you will get minus 10 and you will get minus 20. The reason you get more in equity than fixed income is you have to incur the volatility. So while 12 to 15 is what your equity markets should give you, remember it's not year on year.
Any themes that come to the mind that have consistently performed over the last 10 to 15 years where the investors watching us today could be reasonably sure, and I have used the word reasonably sure, of getting those similar kind of returns over the next 10 to 15 years as well?
Okay, so I don't fundamentally think thematic investing is good as a core part of your portfolio, especially for young investors. We did this exercise at Edelweiss AMC, where we looked at the so-called popular themes every year and the kind of returns you would make if you had invested in the popular themes. And we found that actually if you had done this, and I think we did gold in 2013, debt in 8, all of that stuff, you actually made less money than just investing in diversified good companies represented by the benchmark indices. So I think a lot of hue and cry is made about themes, but investors do a terrible job entering and exiting the themes at the right time. What I would highly recommend is you pick a diversified fund. And pick a diversified fund because in India, there are opportunities in every sector. And you really want to be with good companies and market-leading companies in every sector. There is growth in technology. There is growth in cement. There is growth in financial services. There's growth in banks. There's growth in non-banks. So there's not one, there's growth in consumption. So there's not one theme that you need to run after. A much steadier way to approach this problem is via a diversified fund.
And when we talk about diversified, do you also mean to say diversified across the sizes of market cap, or should beginner investors stick with the large cap funds?
So I think beginning investors can do two things. They can either pick large cap funds are good, but they give you very limited exposure to about the top 100 universe, whereas you also want a mix of the power of smaller companies. So large and mid cap funds, which give you exposure to the top 250 companies in India, I think are a great place. Flexi cap funds are another similar category, a little more risk taking, because they move across the market cap spectrum. I think these are the mainstay of pure play equity funds.
We want to talk about a couple of Edelweiss schemes itself, which have generated alpha over Nifty or Sensex over the last 10-15 years consistently?
Yeah, so I think if you had to look at us on the equity side, and the good thing about us is we run very few funds, and that's intentional. So you don't have to choose from a laundry list. On the flexible cap side, we run a large and mid cap fund, which is incidentally completing 15 years of track record very soon. And we run a flexi cap fund that has also been one of the better ones in the category. And then for investors who are seeking more risk, of course, we run popular mid and small cap funds.
And the flexi cap fund that you just spoke about, what has been the CAGR of that?
So I'll tell you, over the last 5 years, Edelweiss Flexi Cap Fund is at about 13.5% the category would be a little less than that. And I'll tell you a couple of other funds. So Edelweiss Flexi Cap Fund is right there. And large.
Is that the regular plan or direct plan?
That's the regular plan.
So the direct plan would be about 50-75 basis points higher?
Yeah, direct plan would be 50-70. And Edelweiss large and mid cap fund is also in the same vicinity. 5 years, it's about 14% in the regular plan.
14%.
14.
So direct would be about 14.5%.
Yeah, direct would be probably 14 and closer to 15. As I said, 12 to 15 is a very reasonable expectation for an equity investor investing in these kind of funds.
Sure. You said that thematic investing, investors almost always get it wrong when to enter and exit the market. But isn't it where the fund manager's expertise comes in? So if I can be invested in a thematic fund, and I can leave it to the fund manager to take those decisions for me.
And I'm saying, no, see, when you're investing in a thematic fund, you are investing in a technology fund or healthcare fund or whatever invest. When you're investing in a flexi cap fund or a large and mid cap fund, it's the fund manager taking the call. Okay, and fund managers do have some ability to think about where they want to park money sectorally. When you as a consumer are doing it, you are the one taking a call that abhi IT karna hai, do I want to do pharma now, etc., etc. And I'm saying individual investors often get that wrong. I'm not saying thematic investing is bad. I'm just saying it can't be the core of your portfolio. I'm saying 80% of your portfolio either has to be simple hybrid funds or simple equity funds. You want to supplement it with a theme here and there, by all means, please do.
Sure. What about small cap? How much of my portfolio should be in small caps?
So I think you should have a mid and small cap cluster in the portfolio. I said cluster because you can divide between mid and small cap. You can do just small cap. You can just do mid cap. Small and mid cap returns will in the long term be higher. I think our own mid cap fund, for instance, over the last 5 years has compounded at probably 15% odd. Small cap investing is good if you give it time. So it's very important to have a 7 to 10 year horizon with mid and small cap investing, and to know that it will be extremely volatile, but there is wealth creation. So I always say again, build a bulk with either one of the flexi cap or large and mid cap funds, supplement it with a mid and small cap cluster, and maybe a global investing cluster.
Do small cap equities and small cap funds, do they tend to do better than the large caps during bull runs? Is it always the trend?
It's not always the trend, but it is generally true that in a bull market, there is risk appetite out there. So your mid and small caps will outperform large caps. There are periods, by the way, where you have had significant periods of large cap outperformance to mid and small cap markets. In extreme bull runs, you saw this in the last year and a half, you do tend to see outperformance. See, small caps and mid caps have to outperform large caps in the long run, because you have to get compensated as an investor for the additional risk that you're taking and the illiquidity.
Yes, but that in the small cap basket, it's also very difficult to identify which of the companies will actually outperform, and then the rest will drag down the portfolio. In
fact, I think mid and small cap is the place where really fund management expertise plays a very, very important role. So that's the place where I think, the role of a sensible fund manager You just can't rule that out.
You spoke about continuing with the SIPs, not redeeming units, not stopping SIPs. Uh, this brings us to the topic of timing the market. No matter how much we try to educate investors, not to try to time the market, they invariably do. Can you talk about that a little bit? Is it possible to time the markets, especially for not someone who's full time into the markets?
Okay, it's very hard to time the markets. I have so many investors who come to me and say, the Nifty is at X level today. If I know that it's going to fall 40%, should I just take out all my money and come back later? And I keep telling all of them two things. The first is, if you knew that, you shouldn't ask me for advice, because that's really a very evolved state of being. Secondly, even if you did know that and you were right, would you have the ability to invest when markets fall 40%? We've just seen about a 10-15% correction in the market, and already people are writing in with their worries, etc. So I think timing is exceptionally difficult to do, and even harder to act on, because there's a lot of noise around it. Which is why I keep telling investors, I mean, I get a lot of questions. What did you do in March 2020? You're an evolved markets professional. And I said, I did nothing. I let my SIPs continue. And in this whole cycle, it is better to just invest, rather than trying to time the market. Timing the market makes us feel very intelligent. You go to a party and people say, market ka kya lagta hai, market ka kya lagta hai. But I encourage you to go back to predictions that have made in the past, and very rarely do they come true. And given a full-time day job that most of us have, me included, timing the market is probably the last thing we should waste our time on.
That brings us to yet another point. Even in the active fund category, we see the SPIVA report that comes year after year. Now, this year's SPIVA report was a bit more benevolent than the previous years. 50% of the funds have outperformed the benchmark, I think. But in the track record that we have seen, that about 20 to 25% of the funds outperform benchmark every year, and very rarely it's the same funds. My question to you is, should investors try to churn their portfolio year after year, try to think that this year they can catch the fund that may perform better?
Okay, so I give 2 points. One, I don't pay too much credence to the SPIVA reports. I've stopped looking at them. I think their comparisons, between funds and categories anyway are challenging. People often forget the active versus passive debate, which keeps seeming to happen in India. And, you can debate all you want, is actually not a necessary debate in a country where equity penetration is so off from world averages. And it makes it seem like there's a contest in active versus passive. There is no contest. There is no choice. You choose active, you choose passive, you choose both. It's okay. Actually, that's not the debate. The more important questions are not active or passive. We started this conversation with having 1 crore. You'll get it whether you go active or passive. The difficult thing is sticking around in the correction. The difficult thing is not stopping the SIP when markets are down 50%. Because when markets are down 50%, both your active and passive fund will be down. One will be down 50, one will be down 55, right? So I think, one, I just want to focus in on what is the right question to ask. And I think you can't predict when active funds beat passive funds. When the market rally we've seen tends to be more broad-based, active funds tend to do well. Active funds often tend to do well in periods of correction. Passive funds tend to do well when the rally is concentrated. So no one can predict this. And as I said, it's not an and-all contest. And if you look at the data for small and mid caps, it's actually very encouraging for actively managed funds. The other thing is, just as investors do not a very good job in timing themes, they don't do a very good job in timing which fund to do at what time. In fact, I often tell people, look at some of my underperforming funds, because performance does have mean reversions. Performance is not magic. There are different fund management styles, and styles go through periods depending on market cycles. So what is more important for a consumer is to understand the fund, understand what the style of the fund manager is, to understand when it will do well, and when it will not. And certainly churning your portfolio every year is just going to cost you a lot of money in taxes.
You spoke about long periods of correction and sticking around those. Um, we hit 18,600 on Nifty sometime back, and then since then Nifty has been struggling to even stay at those levels. So Nifty has been struggling to stay at those levels. Are we in for some time correction, at least if not the price correction?
So again, it is hard to predict. We have had 2 years of an extraordinary rally coming back from COVID. And even this year, we've held up as one of the better performing markets. As a team, we do believe that this year, in particular, the first half of this year, was going to be exceptionally volatile. We had put out a note to this effect, I think, sometime in December last year. And there are geopolitics at play. There is everything that is happening with global interest rates rising. There is inflation at play. I would say for new investors, this volatility is going to come across as surprising because this is the first time. And I really believe for many of them, it is a test. But markets, as I said, give you time corrections, markets give you volatility, and markets give you years of 10 to 15% negative returns and even larger ones. So all of those are possibilities. Our hope is that the one positive from an India markets point of view has, of course, been the earnings outlook. And if the first half of the year subsides and we get to a period where the earnings outlook looks reasonable, then hopefully we will have a steady year ahead. But as I said, in the business of markets, you can't rule out any of these three outcomes.
Is the US interest rate outlook an immediate threat to the global equity markets?
Look, I think it is something that has been talked about, accelerated, and largely priced in. Markets work on expectations. But do remember, last year was a year that benefited from very, very high levels of liquidity, both in new investors coming into the market, in primary markets, and especially in secondary markets. So if there is a sustained, and I would also say rising interest rates is not always bad for equities in the long term, but will it create volatility? Definitely will.
Long periods of time corrections, so-called time corrections, where the equities do not move much on the upside. Could that actually be beneficial for an investor who's looking to accumulate wealth over a period of 10 to 15 years?
Actually, for an investor who's looking to accumulate, periodic corrections and the ability to take advantage of them, time corrections and more than that, price corrections are very good, because if you're an SIP investor, as I mentioned at the start of the conversation, you can accumulate serious amounts of units. And if you are a disciplined investor who doesn't fall prey to the noise, then you can use it to accumulate more.
There's one theme that is very much in play right now, that is technology and so-called growth stocks. Would you want to talk about that? How's the outlook for those kind of stocks over the next 5 years in India?
First, I think technology is no longer a sector. It is a significant theme, and we run one of India's largest US technology-focused companies. And if you look at historically, even the earnings of the S&P 500, technology stocks have played a significant role in driving that. And I think I see no reason that will change. Technology investing is easier said than done, because the winners keep on changing. It's also extremely volatile. Technology stocks, as I said, have seen a material correction, and perhaps the correction will give investors an opportunity who were looking at these names to add. These have historically been high PE, high beta names, high PE names. And typically when companies like this disappoint and have even a minor earnings miss, the market punishes them very harshly, which is what you're seeing in the US. In the Indian context, I think technology is very different from the US. There are two kinds of technology companies. There's Indian IT, which I think is been the bellwether and stable. There's also New Age India technology, which is listed. I think that is very different from the US. I think US technology companies, especially the bigger ones, are established, profitable, known business models. I think in India, if you're looking at New Age technology companies, you have to be a lot more discerning, because these are companies where the business models have to be proven. Unit economics are still unknown. They're just getting their governance act about right. profitability path is unclear. So I think in India, if you're looking at recently listed tech IPOs, for instance, just price falling doesn't mean buy.
Yeah, talk about diversification within mutual funds. I'm a young investor. I'm just starting out in my first job, started doing SIPs, taking this advice of sticking. How many mutual funds should I spread my money across?
I would say your portfolio should have probably about 5 categories of mutual funds.
Categories.
A
Okay.
large and mid cap or a flexi, a mid or small cap. Maybe if you're conservative, a hybrid fund like Balanced Advantage, and 2 fixed income funds. Okay. And within each category, 2 funds per category. So 8 to 10 at maximum.
Uh,
And this is your core portfolio. Then your satellite can have a couple more.
which can have one US funds scheme, one thematic scheme.
Exactly. So that you can do. And I did mention international funds, etc., because you said you are a new investor. And I think international investing has to happen when you evolve a little more.
The two debt fund categories that you spoke about, wouldn't that actually drag down my portfolio returns, overall portfolio returns? Why should I go for debt funds?
This is something a lot of young people ask me, why should I account for debt? Because while growth is important in your portfolio, there are times like this when markets correct and you need cash, you need liquidity. So firstly, you need places where you can park contingency money, and contingency money cannot be parked in equity because equity can fall 50%. Contingency money was meant for a house payment and suddenly equity is falling 50%. And you need a shield in your portfolio. Most people believe that they are long-term investors. But that long term quickly goes out the window when they see their portfolios come down significantly. So debt is a very important hedge in the portfolio. It's the same reason we have a balanced diet in life.
Other than young investors, people who are already in their middle stages of their lives, what advice would you give them to become crorepati or accumulate a significant amount of wealth?
So I think if you're in the mid stages of your life, really investing has to be goal based. I think what I recommend to each stage of investor is young, old, whatever. Figure out goals, and a very simple framework is short term, medium term, long term goals. Less than 1 year, 1 to 3 year, or sorry, 1 to 3 year goals, 3 to 5 year goals, and 5 year plus goals. 5 year plus goals go into equity, 3 to 5 year goals go into hybrid funds, and less than that goes into fixed income. Now, if you're approaching retirement, etc., of course, then you have to start planning for that with a very different story about income. So that's a much longer conversation. But I would really encourage people to think about investing in terms of goals. It really simplifies everything.
Radhika, thank you so much for taking out time for us today. It hopefully is just the beginning of series of many such conversations.
Perfect. Thank you so much. It was great talking to you guys.
Thank you, Radhika.
Thank you, Radhika, for this insightful discussion. Moving on, our next session is a panel discussion on how to multiply your wealth and become a crorepati with mutual funds. Let's welcome our esteemed speakers, Nilesh Shah, who's Managing Director, Kotak Mahindra Asset Management Company Limited, Anupam Guha, who is Head for Private Wealth Management, ICICI Securities Limited, and Jitendra Solanki, who is founder of GS Financial Advisors and also a SEBI registered investment advisor.
Hello and welcome all. This is Manage Your Money. We are discussing today if you can become a crorepati by investing in mutual funds. I'm Shaleen Agrawal from Financial Express Online. We have with us today Nilesh Shah, Managing Director, Kotak Mahindra AMC, Anupam Guha, Head of Private Wealth Management at ICICI Securities, and Jitendra Solanki, Founder of GS Financial Advisors. Nilesh, Anupam, Jitendra, thank you so much for being with us today and welcome.
Thank you, Shaleen. Thanks.
Nilesh, we'll begin with you. Simple question. Can an early stage investor, a young person in early stages of their career, can they aspire to accumulate 1 crore rupees by investing in mutual funds?
Well, if you look at the last 25-30 years history of modern mutual funds in India, many people have become crorepati. But can you keep a target of crore? Answer is clearly no. In 1990, what was the value of 1 crore is not the same value in 2022. In 2022, what you think is the value of 1 crore, in 2040, it will be substantially lower. inflation is coming and hitting at the nominal value of currency. So please don't keep a target of trying to become crorepati. Please keep a target that I want financial freedom. I want financial independence. एक advertisement थी, सर उठा के जियो. All of us should aim to get financial independence, financial freedom through investments. And in that, mutual funds can play an important role.
Sure. Anupam, if we keep aside a target of 1 crore rupees for now, but think about accumulating significant wealth in mutual funds. What does one need to do to accumulate a significant amount of wealth over a decent enough long period of time, let's say 10, 12 years?
Yeah. Thanks, Shaleen. So I, in fact, echo what Nilesh just spoke about. And there are two broad concepts here, right? One is really the power of compounding in a country like India, where long-term equity returns have been, say, closer to 12%, right? Power of compounding can really help in creating the wealth, provided that we put a structure around it and be disciplined about it. And second concept I think he spoke about, which was really about inflation, because inflation tends to eat away, right, your savings, and hence I think seldom people realize the magnitude of it. And I think the more awareness we have around it, and I'm really happy that we are having this talk today on your show. So for me, really, personal finance, and that's what we've been doing for the last 20 years, is more actually personal than we come into the finance bit, because it's so specific to our investors, right? Because every individual and every investor is at a different inflection point in their lives in terms of what they're wanting to do. And hence, it's very important for the investor to really understand what are their goals, what are their objectives, what is the risk-taking ability, and what are their near-term and short-term cash flow requirements as well. Because once they have that understanding, and for that, people like us who are financial advisors are available in the market, where they can really help build this structure or this conversation, because it then really puts a plan in terms of how you would want to create your asset allocation framework. Because once you have an asset allocation framework broadly in mind, right, you know what kind of return expectations you have, what kind of risk appetite do you have, what kind of drawdowns or the negative returns can you take, you can then construct a portfolio. And for us, what's happened is that mutual fund as a tool is extremely, I would say, a very powerful and a simple tool that any investor can today use. So for us as wealth managers, of course, you have the entire gamut of products and services being available. So right from direct stocks at one end to bonds to managed funds like mutual funds are available. But mutual funds specifically is very powerful because it provides an ease of investing into the markets, both equity, debt, and alternates. Mutual funds allows you to really provide you liquidity. It's a very transparent way of investing, and it's very well regulated. I think what's happened is that SEBI, which is market watchdog, has really created strong frameworks around this product, this tool, which has really provided structure for the investment. And hence, if one way to approach, looking at their asset allocation and looking at the macro, and if one way to start investing in a disciplined manner, either through a systematic investment or lump sum, large sums of wealth can get created, and which really is the need, both for somebody who's a young millennial or a Gen Z, and also at somebody who's maybe at a stage which is late Gen X, say a 45-year-old guy looking at maybe the last 15 years before he retires, because that's another big segment. And in both these spaces, because in one side, you certainly would want to do retirement planning, and on the other side, for the millennial and the Gen Z, you have the great need for doing systematic investment and creating a structure to provide wealth. And in both these cases, through the power of compounding and playing the markets, or doing asset allocation, one can create wealth.
Jitendra, Anupam said two things, whether SIP investing or lump sum, both can create wealth over long term. Any anecdotes you can share or any from your experience, can you tell us which one is better, SIPs or lump sum?
If you look at wealth creation strategies, now SIP or lump sum, it's completely, one is dependent, on convenience, and lump sum investment, target much on, when you are actually investing. Much unlike in a SIP, you are averaging out your cost. So whenever you start, it won't matter. But when you look at lump sum, then really when you started, is going to matter, at the end of your target goal. So if we compare both these investment, yes, lump sum investment, if you have started at a very low market level, you are going to get much higher return than an SIP, right? But if lump sum investment, say you started now, and probably you achieve, and markets have not risen more, then probably in an SIP you will achieve much more average returns. So when you look at both these strategies, yes, lump sum investment can make can give you higher return than SIP, because SIP is much more of averaging out your cost. It's not much more on maximizing your returns.
Nilesh has been a very big proponent of SIPs. I've seen several videos of Nilesh where he puts some question to participants and say, if you answer, I will answer your question, but then the condition is that you have to start an SIP into any of the mutual funds. Jitendra, will stick with you for one more minute. Is there any calculation on how much money should one put aside, either in terms of absolute value or in terms of the percentage of their incomes or their wealth, month on month, over a period of, let's say, 10 to 15 years to be able to reach that magic mark of 1 crore rupees?
Okay, so let me give you a figure. Okay, so obviously must depend on the return you achieve. But suppose you are targeting a 12% return, and we take a 20-year time frame, or you take an 18 years, then a 15,000 per month will achieve you 1 crore. Now, increase it to 15% return, you will be able to achieve in 15 or 16 years. So I think with an investment of 10,000 to 15,000 in a 15 to 20 year span of time, you can achieve a target of rupees 1 crore with a return target of 12 to 15%.
Nilesh, is there any data available or which funds have been consistent performers over the last 10 years, which have given consistent returns to investors over the last 10 years?
So why do you want consistent performance and consistent return?
Okay.
Sachin Tendulkar is the greatest batsman. In every inning, has he scored 55 plus run? There are days when Sachin Tendulkar got out on 0. There are days when he scored just 25, 30 runs. And there are days when he scores triple century. Now, will you judge Sachin Tendulkar for his greatness based on his consistency or based on the runs he has scored? Muhammad Ali was the greatest boxer. Didn't he lose any match? Didn't he suffer any blow on his body? So when you're investing in market, please remember that markets will go up and down. There's no fund manager which can consistently deliver positive return day after day. There will be ups and downs. There are some people who follow growth style, some people who follow value style, some people follow growth at reasonable price style. There are days when kachra stocks run and the good quality fund managers will underperform. There are days when kachra stock will fall and we will outperform. So when you're investing, don't look at the past performance. Look at the future potential based on the investment process and the portfolio. You have to invest in understanding fund manager, his process and his portfolio in order to get confidence that this is the fund where I can invest for next 5 or 10 years. And once you invest, it doesn't mean fill it, shut it, forget it. You still have to monitor. Fund managers can change. Fund style can change. So you need to monitor. And you need to also create a complementary portfolio. You don't put all eggs in one basket. You don't back just one fund. You take advice of people like Anupam and Jitendra to figure out which funds are more suitable for me. There is no one right size that fits all investors. There are some conservative investors, maybe they should be happy with large cap funds. There are some aggressive investors, maybe they can take the risk of small and mid cap funds. So, there is no simple answer. If money making was so simple, all of us would be billionaire. The fact is that money making is difficult. It is very commonsensical, but people generally don't apply common sense when it comes to money. You need an expert advisor who can help you navigate through the ups and downs of the market. You need to build portfolio of assets which will help you generate real rate of return. And that real rate of return consistently created over the year will be your reward of financial independence.
Sure. You said very nice things about understanding the fund investment philosophy. A retail investor, how does a retail investor go about analyzing all those things when you yourself said that even fund managers find it difficult to consistently perform?
So, मतलब बहुत लोग मुझे ये कहते हैं कि finance कितनी difficult चीज है, how do we pick up? Well, as I mentioned, finance is all about common sense.
Sure.
It doesn't require too much of research. It doesn't require too much of analytics if you can use your common sense. For example, there are institutions with a brand. Now, you can trust them. Then there is performance of the past. Again, you can look at them. Then there is offer document, SID, or on the websites where they have written things.
What to look for in those documents? For a retail investor, what to look for in those documents?
They have to look at about what is the investment process of this fund house, what objective they are trying to achieve in this fund, what risk management policy they have. These are exhaustive documents which one has to study. It's not a fictional novel for reading, which will be entertaining. This will be serious reading, but those readings will give you the confidence to remain invested through the ups and downs. Sure. Now, most investors will say कि हमारे पास इतना time नहीं है, which is a fair thing. That's where people like Anupam and Jitendra comes into play. If you ask me which fund to invest, I'm bound to say Kotak mutual fund, which is where you have to trust people like Anupam and Jitendra who will say that, okay, apart from Kotak, hopefully there are other mutual funds also which are worth investing into. They have team which does research on fund houses on a regular basis. They have experience of our past. They have understanding of our portfolio's future potential. So many a times when you don't know which medicine to take, you go to doctor, and then doctor will prescribe that these are the medicines. So what you do for your physical health, you have to do it for financial health.
Yes. Anupam, which are the sectors that you would say?
Shaleen, if I can just come in and maybe add my 2 bits.
Please.
What I just spoke about. Yes. See, the point that I was earlier trying to make is that in mutual fund today, SEBI has really done a very beautiful classification, which is very simple for investors to look at, right? So say, for example, in equity, you have 11 broad classification, right? You have within market cap, say a large cap, mid cap, small cap, mid and small cap, say a flexi cap, say a fund of fund, and overseas, and likewise on the debt side, you have right from an overnight, ultra short term, all the way up to duration, gilt. Depending on what you would want to play or how you would want to construct your portfolio, you have instruments or categories where you can invest in. I think what is more important is, if you really want to create wealth, is to be invested. And the time that you spend in the markets or the time that you spend in investing, and which is where really the power of compounding came in. And I think some statistics Jitendra also mentioned about, and I may just want to highlight, there's this thumb rule 15, 15, 15, broadly rough and ready, which is to say that 15,000 SIP for 15 years, 15, 16 years actually, at 15% can give you 1 crore.
Okay.
Or, the rule of 72, which is to say that, at 12, if you're looking at 12% return, then in 6 years, you double your money. Right. And we've all heard about how Warren Buffett created wealth and a massive wealth creation that's happened in the later phases of his life. And that's surely because, how he's allowed the money to grow. And
yes,
that is what people will have to, and investors will have to realize, that they need to bring discipline and structure to their investment process. And that is where both mutual funds come in and people like us come in, who can help and guide the investor to really build that structure. And that is why I spoke about, it's more personal than finance. The second bit is that basis their risk appetite. So say, for example, for somebody who's early in his age and is willing to take risk, he may want to maybe, and I'm saying you, because you also now have a riskometer in mutual funds, very simple, right? It tells you that what kind of risk the underlying fund or the category is. And say, for example, you say that, hey, listen, I, can take higher risk, and hence I want to be a large part of my portfolio into, say, equities. And within equities, then you structure that, okay, what kind of sectors do you want to play? And I think that is what you were trying to also maybe allude to in terms of what sectors do we believe that could do well. So, right. So I'm saying eventually it's all about what category selection, that your financial advisor can help you do. So first you get your asset allocation right, then you get your category right, then you get the right fund, and really then help execute the strategy. But I think what's important is really to understand, and also if I were to give you one or two other anecdotal, thumb rules. So say a 10,000 SIP, right, at 12% becomes 1 crore in 20 years. But a simple thing, what you do is that you do a 10,000 SIP, do a step up of 10%, right? So what are we saying? Here you are a salaried young investor. Every year you may get a little bit of bonus and you will, have a salary hike. So the SIP that you're doing 10,000, what you do is you take a 10% step up in your SIP and you add 1 lakh rupees every year. Suddenly the 20 years that would take an investor to make it 1 crore will, fall to maybe a 14 years. And that is really the power of a systematic structured investment. I'm saying within this, you will have volatility. The idea is really, not to get too much faced with the volatility. Obviously, if you as an investor are an expert, it's great. Otherwise you have, financial advisors who can really help and support you in terms of navigating the market. But I'm saying irrespective. And within asset allocation, you have two broad, again, theories. One is really your strategic asset allocation and one is your tactical allocation. Strategic allocation is basis your goal, your risk appetite, etc. You create a framework and you really don't have to look at it too often, unless, of course, there is a change in. So, say for example, you get married and there could be, both these spouses are working and you have more surplus money, or say for example, you get some inheritance and suddenly you have more money. So that is where you have. Maybe you want to relook at your, how does my overall asset allocation looks like? Or say, for example, there is a loss of job on the negative side. And suddenly you want to rework in terms of, boss, I cannot now pay my SIPs. How do I really look at, my overall allocation? And then you have a tactical, which is largely dependent on the market. So say, for example, of late, you would have heard that, RBI, say, for example, increased the repo rate by 40 basis point. Fed, has increased the rates, etc. So, and within that, there were, say, for example, drawdowns on the equity side. There's been pullback of money by the FIIs, and on the debt side, suddenly it's now started looking attractive. So you have opportunities like these through which you can play the market, both on the debt side and on the equity side. And if you also take maybe a 10-year rolling return, you will see different asset class and different category of investments have done differently. So equity has in some years have performed better than, say, for example, gold versus say an international investment versus fixed income. And finally, for us who are, our job is to really do asset allocation and do manager selection and really help the customer execute the strategy.
Anupam, are you saying that when the markets fall, you should try to invest more in markets?
I wish, Shaleen, it was so simplistic, but yeah, as a thumb rule, the idea is that, see, finally, how do you really invest, right? Is the structural story in India strong? The answer is a big yes.
Okay.
The macro supported broadly, the answer is yes. There are headwinds in terms of inflation, commodity price, which may have challenges in terms of squeeze in margin, etc. But I'm generally saying that at 16,500, right, you may just maybe want to wait a little bit more for if you believe that there could be correction, but you wouldn't go wrong, right? And I'm saying that volatility, you have to not get unnerved with volatility. And I'm assuming that most of our listeners and investors are the younger lot, the Gen Z. Really, you will have to tide this volatility, make volatility your friend. And yeah, so in a very simplistic term, if you believe that the fundamentals are strong and you have opportunities to investing at a lower rate, is definitely you may want to allocate and really then, but the underlying is that you have to look at quality, you have to look at good management, you have to look at earnings, both at the sector and at the stock level. And hence, I'm saying mutual fund is a construct of the underlying stocks, and hence, some of these schemes. And because you have mutual funds where you have fund managers who do all of this for you, it becomes so much more simpler to go and pick up quality fund houses, quality fund managers, and invest in them.
Nilesh, will try it one more time. Which sectors are poised to do well in the next 5 years or 7 years or 10 years, whichever period you're comfortable with?
So if you look at sector, you must remember that within a sector, there will be someone who will be a great entrepreneur and someone who will be a bad entrepreneur. So as much as sector selection, it is important to also back right management. In IT industry, not everyone is Narayan Murthy or Azim Premji or Shiv Nadar. In banking industry, everyone is not, a good banker. There are many not so good banker also around. So you have to invest in good management, good promoter, good businessman. That is very, very imperative. Now, India is a rising boat. It's a rising tide. Every industry, every company will get lifted by this.
Mm-hmm.
Some may get lifted more, some may get lifted less.
That's what we are trying to find out, which are the ones that will get lifted more.
शालीन भाई, आप है ना पहले बोट में बैठना सीख लीजिए. उसके बाद कौन कितनी ऊपर जाता है वो देखेंगे. किनारे पे रह के मुझे वही बोट में बैठना है जो सबसे ऊपर जाए, वो गलत बात होगी.
Understood.
First, please remember to get into the boat, because even if it rises less, it's fine. You are still in a rising boat. From a sector point of view, if you see, there are few trends which are changing India. What are those trends?
Mm-hmm.
If we look at India's manufacturing industry, it has done well over the years, but it has performed quite badly compared to peers like China or Korea or Taiwan. In 1980, India and China were of similar size. We did far better than China in IT industry. But in manufacturing industry, China went so far ahead. But today, China is 5 times bigger than us. They became manufacturer to the world. We became back office to the world. Now, China plus one strategy is being followed by many companies around the world as they want to diversify their risk away from China. Now, there are many countries chasing this China plus one. India is also one of them. And we believe there will be golden period ahead for India's manufacturing industry over next 5, 10, 15 years, thanks to this China Plus One. We have a large domestic market, and now we are going to get access to the global market. Any company which is capturing this trend will be a winner over next 10 years. Now, this could be companies in automobile space, auto component space. They could be in solar panel manufacturing. They could be in API and bulk trucks. They could be in mobile handsets. They could be in electronic components. All these sectors are supported by government under production-linked incentive scheme. So manufacturing stroke PLI combination will lead you to companies where there could be tremendous wealth creation opportunity over next decade. The second thing which is happening in India is financialization of savings. We were always a good saver, but when it came to investment, we were a lousy investor. Our allocation was more towards gold, real estate, and black economy. Now, thanks to technology, tax compliance has improved. Thanks to understanding, financialization has started happening. People are now saving more money. People prefer to save more money in mutual funds, insurance policies, bank deposits compared to the past. And this trend is likely to accelerate in the days to come. So you have entire financial services sector available, be it bank, be it health insurance, general insurance or life insurance company, be it asset management company, be it microfinance company or NBFC company. In this entire segment, you will have great opportunities to create wealth. We have seen how private banks have created wealth over the last 20-25 years. More such opportunities will come across financial industry spectrum over next decade or so. The third theme which is working in India, especially in the near-term concept, is the real estate. Real estate was contributing 12% of GDP a couple of years back. Today, it came down to about 8% for a variety of reasons. But now we believe real estate is changing. One, affordability has improved as house prices have remained constant or fallen, whereas income levels have gone up for certain sets of people. Second, housing loan is available today at 6.5%. It's even cheaper than government's own securities. Third, thanks to RERA, now developer and consumer interests are aligned. पहले तो डेवलपर कंज्यूमर को फुटबॉल की तरह खेलते थे, कभी यहाँ फेंक दिया, कभी वहां फेंक दिया. Now their interests are aligned. And most importantly, there is demand for housing for a variety of reasons. Nuclearization of family, work from home requirement. Put all these things together, do we see housing, real estate going back from high single digit to low double digit contribution to GDP? Answer is yes. And sectors which are involved in real estate, be it property developer, be it building material supplier like cement, paint, tiles, be it consumer durable company, be it housing finance company, they'll all benefit from this mega trend. So manufacturing, financialization of savings, and real estate, these are the sectors where we believe there will be opportunities in the coming 10 years.
Sure. Nilesh and Anupam, in the same spirit, very quickly, the sectors which will be under pressure in the near term because of any reasons?
See, again, sector में tension नहीं है. Tension हमेशा खराब promoter में है.
Of course.
अगर promoter चोर है, तो वो आपका पैसा अपनी जेब में डाल देगा. So don't worry about sector. All sectors will go up in the rising tide of India. Some will go more, some will go less. But please ensure that you are not with the promoter whose concern for minority shareholders is not there, who is indulging into malpractices and misgovernance. You will always lose money with the bad promoter.
Sure. Anupam, do you want to add to that?
Yeah, if I can just add. So I, completely echo with what Nilesh just spoke about, right? To all our investors and listeners, right? It's very important that, don't be on the sidelines. If you really, because you see, inflation is for real. And I'll also give you some, just the way we spoke about compounding and the power of it, right? The same example that we gave, that 10,000 bucks put in for at 12%, which is, your long-term average for, say, Nifty for the equity market, can really give you 1 crore over a period of, say, 20 years. And you just, put in a little bit of SIP, step up, and then 1 lakh of lump sum, that 20 years becomes, 13, 14 years. Likewise, for inflation also, say, for example, if my today expense is 1 lakh rupees, right? And I'm, say, for example, 45. When I'm retiring at 60, just to maintain the same lifestyle and expenses, I would maybe need close to 4-5 crores, right? And that is assuming that I will continue to invest in equity markets at 12% with inflation at maybe 5-6%. So both power of compounding and inflation, if people understand, they will realize that they will have to invest rather than being on the sidelines. Depending on the risk profile, I am saying you have the choice and the variety to invest in. What Nilesh just spoke about, some of the themes, like, say, for example, financialization, digitization, healthcare, right? EV within auto, they are big themes, right? If we believe that, yes, I'm saying again, if you look at the last 3 years, what's really done well in equity, consumption has done really well. Quality has done very well, right? Even if it was expensive, it did very well. Going forward from here on, we believe that maybe capex cycle revival will happen. You would have, earlier people would say IT and pharma, defensive sectors. We are now saying that, hey, listen, there are structural shifts. Digitization is for real, right? We are doing this call on a Zoom. Also, and people are digitizing. COVID has really, so all of those things will play, and they are plays for the next 10 years. How do you play this? As investors, if you have the acumen, please invest directly in stocks. But if you do not have the time or the acumen, you have mutual funds as tools, which are simple, transparent products, and cost effective, by the way, where you have experts who really manage it for you. And like how Nilesh spoke about some of the sectors and I spoke about it, I'm saying within that, if you want to play the markets, if you really want to look at small cap, you have the small cap category. If you say, no, listen, I only want to play with the big companies, I do not want to take, because with higher expectation of return, you also have higher volatility and hence, higher standard deviation and higher risk. So, you will then say, no, I only want large cap, or you want a mix of large and a mid cap, or between equity and debt, a combination, say balanced funds, hybrid funds. So today we really have great and beautiful classification for investors to pick and choose, categories as they want. And they also have, thematic funds and sectoral funds to invest into. So if you really believe that, hey, listen, banking will do well, private banks will do well, you have, themes that you could play around. If you think infrastructure will do well, you have mutual funds that really help you. And, it's so much more simplified. So my request and urge to everybody here, all investors, would be to, continue to invest and be in the markets, opportunities, and make volatility your friend, and use opportunities to really do tactical shift.
Thanks very much, Anupam. Actually, that's a very detailed answer. Jitendra, will come to you. You also mentioned 12% returns expectation in an example. Anupam also mentioned 12%. Is that the realistic expectation, or is that just a hypothetical number? In next 10 years, what is the reasonable return that one can expect from equities?
Well, I think, if you are, say, investing through an SIP mode, right? And if we look at the historical, returns from even from SIPs, from mutual funds, equity mutual fund, then I think 12 to 15% is a quite reasonable return one can expect Okay, if I look at what return, higher return I should expect, I am investing into equity market, I may go up, 15 to 18%. But being a mode like SIPCs also depends on what mode you are investing. What happens is that, investors, generally follow the returns, probably what a lump sum investment when you have invested in the downside market and what returns it is giving you, investors tend to follow the same return in the SIP. And let's understand most of the money which is coming into equity mutual fund is coming through SIP mode. And when you are investing through SIP, it is more for, one is ease of investing. Second is averaging out your cost of purchase, and your return does not get maximized. Okay, it does get optimized. So you need to expect a reasonable return. And I think 12 to 15% is a reasonable return one can expect when you are investing into equity mutual funds.
If I can, since you brought up this point, sorry.
Yes, please.
You see, what we are here talking about long-term trends and long-term average returns that the markets have given.
Yes.
At no point am I saying that drawdowns or negative returns clients may not expect, and which is the point on volatility. Because if you see this year, right, markets are down by what? 6%, 7%. This calendar year. You look at 2018, we had almost negative returns in equity. And if you look at 10 years, maybe you will have 3-4 years where markets have given negative returns. But if you continue to hold on to your investments and, as Jitendra was saying, bring in discipline of investing, it will just do averaging in good times and bad times. And hence it brings, more steadiness or steadfastness to your overall return.
That's exactly why we are talking about longer term horizon. My belief is, and please correct me if I'm wrong, my belief is that whatever volatility, if you stick around in the markets for 10 years or 15 years, that eventually evens out and gives you fairly good returns. Please do correct me if I'm wrong.
No, I think, you are right. And when we are talking about investing into equity markets, and the way, when we talk about investor behavior, now, you talked about reaching that 1 crore. Now, an investor can reach that 1 crore, when he keeps, investing in whatever market scenarios are, right? Generally, that doesn't happen. We see most of the investors, when there was a market fall, we have seen, the investors just get panic and, stop their SIPs and, redeem their money. So, if an investor have patience of investing, continue investing, whatever market scenarios are coming, whatever adverse market scenarios coming, if one has patience of investing in the long term, I think reasonable returns one can expect, right? As I said, 12 to 15%. So when you go through different market cycles and when you are doing through SIP investing, you are actually, making your money whenever you are going through those adverse market scenarios, right?
Yes.
When we compare it to lump sum, I have to be, on a target that, yes, if I am investing, say, in a market index of, 50,000, if I'm investing a lump sum money, it has to go up to, 70,000 to make me, so much returns. But with an SIP kind of a, strategy, even if market falls down, I would benefit, right? So that's the prime, for any investor who wants to, become a crorepati in equity, from equity investing, or want to earn return from the long-term investing.
Jitendra, any names off the top of your head? Which mutual funds would you advise your clients right now to invest in for next 5 years or 7 years?
Okay, as Nilesh said, so we are advisors, so we can name other mutual fund scheme. But if you look at, the best of the schemes, which have done well, when you track, 10 years, then probably from equity large cap, you look at ICICI blue chip, which has done well. When you look at, flexi cap, your Parag Parikh, flexi cap fund, it has done well. When you look at mid cap, you have, SDFC mid cap opportunities, which have done well. Similarly, small cap, SDFC small cap has done well. So there are, good funds which have done well in the past 10 years. But I think, when it comes to investing, that's where an investor has to be cautious, and has to analyze continuously that what has achieved in the past, what mutual fund says that what have achieved in the past may not be achieved in the future. Okay, and that's where an investor has to be cautious. And within all categories, I won't say that you as an investor I go to the topmost fund which has done well, but I think within each categories you will find 2 or 3 funds from different categories, from different AMCs, you will find which has done well. And for investor, it doesn't matter whether you are invested in those 2-3 funds. Okay, so in a mid cap, whether I'm invested with HDFC mid cap opportunities or I'm invested in Kotak emerging equity, both funds are really doing well. Okay, so that's where the choice has to happen.
Yeah. So on the same point, I can only say that the value add that your wealth manager or your personal financial consultant does is really to analyze the universe. So one is that within mutual fund, it's now become very simple and structured. But within that, because you today have maybe 900 schemes available and an investor may just get confused, your advisor really comes in and does 2-3 broad things, apart from what I already spoke about, which is on the broad asset allocation and all, is really to do fund manager selection or fund, so once you've decided that, hey, listen, this is the category I want to invest into, within the category return, there are 2 things that one will have to look at. You have an average category return, and within that, you will see variance of the best performing versus the worst performing, and there is fair bit of divergence. So how do you really pick up those one versus over the other? And the second is, say, for example, if I were to look at, a 3-year return on a 10-year rolling basis, really you would also see what is the probability of beating the benchmark and which funds would, show that probability of higher, success versus somebody else. So some of these parameters is really where, as a financial advisor, you add value and you do the selection of one over the other, which really helps to optimize the return for investors. But the bigger thing is really to be invested and get your broad structure right.
I'll add on that, one point, where we as advisors, when we, are in discussion with, investors, lot of return expectation happens from your neighbor's return, right? I have got a return of 12%, and I know very well with 12% I can achieve my goal. But my neighbor has a different fund which has given him 15%. So why I'm not into it? Okay. I think that's what need to change. And when when your investments are aligned to your goals, and when you have a return target, right? Then I think as an investor, I have to be on that return target. If 12% is meeting my goals, and if my fund is giving me 12%, then that fund become best fund for me, right? Some other fund might be giving 15% or 14%. That may be best fund for the next investor. But if my fund, which I have done selection, and if it is giving me 12% return, I am able to achieve my goal. I think that fund becomes the best fund for me.
Sure. Nilesh, I want to talk about small cap versus large cap investing for a while. Kotak itself has a small cap fund which has done really well over the last 2.5 to 3 years. If we look at the returns, I think it has tripled in value on a point-to-point basis. My question is this: last 2-3 years have incidentally been a bull run market. So considering that, my question is this: do small cap equities or small cap mutual funds tend to do well, better than large caps during bull runs?
So again, why will you evaluate the equity fund on a 2.5, 3 years? It's absolutely wrong measurement. You are investing in equity with 5-year, 10-year, 15-year, 20-year horizon. If you have time horizon of 2.5, 3 years, please come into debt fund, please come into hybrid fund. 2.5, 3 years is not the right time to measure a fund, especially equity fund. Now, coming to large, mid, and small, they all have different characteristics. Large fund, large cap stocks, by and large, have lesser volatility, and hence they deliver lesser return compared to small and mid cap, which has higher volatility. There is no free lunch. A small cap fund or a mid cap fund does well when small and mid cap does well, but that also comes at the cost that they will also fall more. They will have higher volatility. So when you are building portfolio, please take into account your risk profile. There is no straight line in equity market. It is always up and down. When your small cap fund will be down 30%, will you go and redeem or will you go and invest? You have to answer that question honestly to yourself. In March 20, every equity fund was down. What did you do at that time? Did you panic and redeem? Then you are not fit for investment in mutual funds or equity shares. Did you average? Fantastic achievement. You are probably one of this rare person who is able to invest when markets are cheap. If you didn't panic and continued with your journey, maintained your SIP, that's also an awesome achievement. So, Shaleen bhai, the real challenge is not large, mid and small will do well or bad. Global studies as well as local studies have shown that investors' return does not equal to the fund's return. Funds may deliver 30% return and investor may just get 10% because he enters looking at past performance and redeems when markets are down. As a mutual fund manager, my objective is that my client's return and my fund's returns are almost similar. I can't achieve 100% accuracy because people commit at different points of time. But they should get maximum possible return of the fund. And that only happens when you invest on a longer term basis. 2.5, 3 years is not a good time to evaluate a fund's performance. Small cap and mid caps over a period of time will do well compared to large cap because they are inherently more risky and hence they need to deliver more reward.
You spoke about falling, the big falls in the markets. That's incidentally my next question. Is there any way to construct a portfolio which can, at least to some extent, withstand the impact of big drawdowns in the market?
Undoubtedly, it is possible, but there is no free lunch.
Of course.
There's no instrument which says that when markets go up, I'll give you full participation. And when markets go down, you don't have to worry, there will be no loss. If you want to protect downside, you have to let go some upside. You can go and buy put option in the market. There are funds which have delivered that kind of protection. They used to be called capital protection series. So it is possible to restrict your downside at the instrument level or at the portfolio level. Our recommendation is that why not manage it at portfolio level where there is lesser cost? So by doing asset allocation between debt, equity, real estate, gold, and offshore assets, you can create a portfolio which will ensure that you can get real return. Now, when equity markets are down, you can shift some money from debt or gold or real estate to equity. When equity markets are very, very expensive, you can shift some money from equity into debt or real estate or gold. When gold has run up a lot, you can take some profit out of that. When gold has fallen a lot, you can put some money into it. By doing this in a disciplined manner, what we call asset allocation, you should be able to get real return. That is what your focus should be.
I'll stay with you for one more minute. How is that different from trying to time the market, which experts such as yourself have been advising against very much, that investors should not try to time the market? But what you're saying, is it not something similar?
Timing the market and asset allocation are totally different.
Please explain.
Timing the market means that in March 20, you will buy at 7,500 Nifty. And in October 21, you will sell at 18,000 Nifty. I don't think so. Even God will be able to do it. Forget about individuals and human beings. As Warren Buffett said, I have never met a person who can predict tomorrow. Same thing over here. I have never seen anyone who has come 100% correct on the market. What I am mentioning is asset allocation. So let's say you begin your journey in equity mutual fund in Jan 20. Out of 100 rupee of asset, you decided to put let's say your allocation was 40% equity and 60% debt. You put 40% in equity at one go. Ideally, you should have done STP, but for example purpose, let's say you put 40% in Jan 20. By March 20, that would have been down by at least another, 50%. 40 would have become 20. You would have lost a lot of money. What should you do? Well, you should shift some part of your money from debt into equity. Instead of 40-60 ratio, you will make it 60-40. Will you be able to shift all the money at 7,500 Nifty on March last week? Answer is no. You would have shifted some money at 9,000 Nifty, some money at 8,000 Nifty, some money at 7,500 Nifty. And you would not have known that 7,500 is the bottom. So every time you invested, you would have taken more and more pain. But that thing over a period of time will deliver you return. Now markets topped out at 18,500. Would you have redeemed everything at 18,500? The answer is no. But as markets were becoming expensive and your allocation was shifting more towards equity, you would have started taking profit. Maybe you would have taken profit at 15,000 Nifty, 16,000 Nifty, 17,000 Nifty, and 18,500 Nifty. So I'm not saying that you will be able to buy at the bottom and sell at the top. You will be buying when markets are cheap. It will give you short-term pain, but long-term gain. You will be selling when markets are expensive. You will be selling early, but it will give you short-term pain and long-term gain.
Anupam, asset allocation is something that you also spoke about. How often should you reallocate your assets or rebalance your portfolio?
See, within that, as I mentioned, Shaleen, that you have a strategic asset allocation.
Yes.
That you don't have to do too often. Maybe once in a year you should review it in case if there is any change, material change in your overall goals that you had set for yourself. Tactical is really where you would want to move from depending on the market. So suddenly you had, say, for example, a COVID, right? And markets crash. You obviously will have to relook at it, right? Suddenly we are seeing so much of, there is a Ukraine war, oil prices have gone up, inflation in the US, RBI did a report. You may just want to relook at your overall this thing, because these are all opportunities for you to do tactical shift, and which is what Nilesh was trying to say, that if you have a well structured investment model of asset allocation, then you will be able to play different asset classes at different points of time, given that different asset class perform differently over a long period of time. So at some point gold would have done better, and sometime say global equities have really, say US equities have we've seen massive underperformance or drawdowns. While you look at the last 2-3 years, they've really done very well. So how do you really play different asset classes at different points of time is through a structured process. The ability to build this entire structure and discipline is what we are all talking about. Also, Shaleen, while one can play through different instruments, all of these, so which means different product. Say, for example, for the HNI, you may have an AIF, a PMS, a mutual fund, of doing managed equity. While say, for example, you may want to buy direct bonds, or direct stocks. But mutual fund as a tool really offers a very simplistic way of doing all of this. And within this, because there are multiple categories, you also have today, asset allocation as a theme, as a category where you have these balanced advantage fund, dynamic asset allocation funds, which are very smart tools that investors could invest into, because there you are then giving the discretion to the fund manager to really, move between equity, debt, depending on their view on the market.
But then, as Nilesh said, that you're sacrificing some bit of upside in those funds, balance advantage or dynamic asset allocation, right?
Yeah, that's right. Because finally, you will have to see return. Shaleen, there is this, again, a beautiful concept called the risk-adjusted return.
Yes.
Right. Finally, you will have to see return, not in its absolutity, but for the risk that you're taking. For that risk, how much of return are you getting?
Yes. We have a couple of audience questions. These are not our questions. These have come to us from audience. Jitendra, we'll begin with you. Someone has asked us how to identify year after year on which MS will do well this year or next 2 years.
Shaleen, it's year on year which fund can do well. It's I would say it's impossible. Somebody to identify that year on year. Which of the fund can do well. I think you need to, what Nilesh was speaking in the beginning, you need to look at the investment philosophy, you need to look at the processes, and you need to look at, yes, some of the past, returns of the funds which you want, which you want to invest. And as I said, there is no one single fund which you can say, that it's the topmost fund. You will find different funds from different AMCs which are doing well. And I think, that year on year also, beating a benchmark, actually it doesn't happen, because sometimes, even the best of the funds, are not going to do well, right? But if you have a conviction in the fund, right? If you have a conviction on the strategy you have adopted to select the fund, you will stay invested. So year on year, it's not, I would say rather, yes, you review your fund, right? Look at how it is, doing well. It might not be beating a benchmark in, some of the years. It may happen, right? The strategies, the fund managers, strategies may work in some of the years. They might be, looking at some of the strategies, fund manager change strategies, so that does happen. But year on year, beating a benchmark is not, going to happen. You look at more from long-term investment. Okay. And with the long-term investment, we don't say you invest now and you, review it after 5 years or 7 years. Yes, you keep on reviewing the investment and see whether your parameters, which you have selected the fund, are they intact. If there is a change in those parameters, or is a change in the strategy of the fund, then you might, think.
Nilesh, there is another question. Someone has asked us, are there any other avenues, safer avenues than equity, which can grow wealth? And if there are, then why should not we go for those safer avenues than equities?
See, Shaleen bhai, there is no free lunch. Risk and return are two sides of a coin. If you want higher return, you have to take higher risk. If you want safer, if you want safety, please be happy with lower return. Now, everyone wants a very safe product with high return, but that thing doesn't exist. You have to take risk to generate money. Now, why do equities compound wealth over a period of time? Because ultimately, Shaleen bhai, ekdam simply dekhiye, what is equity? It is the business of a company, in some sense, business value of a company. And what is debt? Debt is the borrowing of the company. Now, if company is repaying the debt, chances are that it's doing well. And hence business value will go higher, and hence equity will deliver better return than debt. Now, if debt is, not being repaid, the chances are that equity is not doing well. So debt gets lower return because it is less risky, and equity gets higher return because it is more risky. The same way real estate, same way commodities, same way, newer things. I'll give you one example. We did Google searches on, collective investment schemes. And about 1.5 crore Indians have lost close to 1,80,000 crore in various collective incentive schemes which have been launched in this century. And by no means this is an exhaustive list. This is an exhaustive list. This is just a partial list. This is where the greed comes into play. You want to invest because someone promises you moon. You lose your rationality and go after this and end up losing money. पैसा double हो जाएगा. बस ऐसे नहीं होता है पैसा double. आपका पैसा खत्म हो जाता है. So please don't have this kind of wrong dreams, wrong notions. Risk and return go together. If you want safety, you have to compromise on return. If you want return, you have to take the volatility.
Volatility is the keyword. I really hope the takeaway from our conversation today is that investors stay invested, especially in this period when RBI has just raised interest rates and Fed has raised interest rates and markets are feeling some bit of pressure. Nilesh, Anupam, Jitendra, thank you so much for joining us today. It was really a very good conversation. I hope it helps our audience make right investment decisions.
Thank you, Shaleen.
A great session indeed. Thank you so much, respected panelists, and thank you so much to our listeners for staying with us throughout. We hope to see you again next month for yet another set of insightful series with us. Thank you.